Hello, this is Mike Swanson of WallStreetWindow.com. I've got a very special guest with me today. I'm speaking with David Moadel, who is the Chief Analyst and Researcher for the website PortfolioWealthGlobal.com. How you doing today, David?
I'm doing great, Mike, and thank you so much for bringing me onto your excellent program. I'm a fan, and I'm glad to be here.
Yeah, well, thanks. Since this is the first time we've ever spoke, I thought I'd ask just really quickly if you could tell people your background and your main interests when it comes to markets and trading.
Yeah, absolutely. Well, again, my name is David Moadel, and I do have a channel on YouTube called Looking at the Markets with David Moadel. And for the past couple of years, I've been approached by a number of newsletters and websites, asking me to be perhaps an analyst or researcher in the financial markets. And I chose to join PortfolioWealthGlobal.com. First of all, because of their excellent newsletter, which is free of charge. People can go to the homepage and sign up for that. Their research has been really amazing. They've made some calls in stocks, cryptos, precious metals. Tom Beck, who actually became a multimillionaire in real estate at age 33, he's the main researcher, and he produces the newsletter and many of the reports at Portfolio Wealth Global. And we've had some double, two baggers, triples, five baggers, 10 baggers in many of our calls throughout 2017. And that's why the newsletter became an award-winning newsletter throughout 2017. And we've had an amazing 2018 so far. We're going to keep bringing those calls that can really make people some money. And so I definitely chose to make my home at Portfolio Wealth Global, and I'm proud to be there.
Well, 2017 was a real interesting for the markets. It was up about 23%. However, there's very low volatility. The S&P didn't even pull back once, 5% off a 52-week high. But this year we did get a drop off the high. In fact, we're now just about down 5% after having declined 10%. What do you think that action represents?
Yeah, great question. 2017 was a unique, remarkable event that is not likely to happen again in the near future. That level of low volatility that you mentioned is abnormal, and it was, in hindsight, due to the deregulation and the cutting of the red tape and just the overall optimistic sentiment for U.S. equities, along with the fact that the U.S. started being at full capacity. The economy's gotten better, and investors understood that the recession is finally behind us and we're actually growing. So they bid up the price of stocks with the fact that bond yields are still very low and stocks are still the only game in town. Obviously, we had the tax cuts, and they were already priced in. We're going to have record profits, record guidance, and so there were many opportunities. At Portfolio Wealth Global, we went long the index itself at the beginning of 2017. So yeah, that's a nice 23% gain right there. And remember, Warren Buffett became one of the richest men in the world by compounding his wealth at 19.7%. So 23% in 1 year is quite good. But we also made other gains in 2017 on specific companies that we like for the long term, such as AbbVie, a huge pharmaceutical company which doubled. So it's not just that you need to outperform the market. That's one thing. You need to outperform the market with less risk. That's the idea. That's the alpha. That's where you have added value. And that's what I think Tom Beck, the main researcher and report writer at Portfolio Wealth Global, I think that's where he does best. And if you want to access Tom Beck's personal 2018 asset allocation model, you can actually access wealthglobal.com/portfolio. That's portfoliowealthglobal.com/portfolio. With regards to 2018, yes, 0% price appreciation so far. And I think you can expect 2018 to be a very modest in terms of appreciation for stocks. But I don't think the bull market is over yet. There are plenty of reasons why it can go on for 2, 3, even 4 more years. What I do expect is at some point a 20% pullback. It's going to be very tough on people, and the idea will be to buy that dip, although it won't be a popular idea at the time. And I know that with your listeners, I can tell you that some of them will say that this is the end. This is the big reset. This is everything people have been talking about for years, but I don't believe that it will be. It will be a good buying opportunity, probably the last one in this bull market. And Portfolio Wealth Global will cover some new opportunities at that point. So it's not over yet, but it's definitely taking a well-deserved breather, and I think that breather will end with a sell-off.
Well, do you think stocks are expensive? I mean, the interest rates are slowly ticking up, and as you mentioned, one of the justifications for the bull market has been to get those dividend yields on stocks when yields are so low in the bond market. But if yields tick up, does that mean stocks aren't as good of a bargain as they were a year or two ago?
Yeah, it's a great question. Talking about bargains, I mean, stocks in general are not bargains right now. I believe they're at very high multiples, very high PE ratios, and that's due to low interest rates, really zero interest rates or near zero. So if you factor in that, they're probably fairly valued. And that's why a lot of people are holding on to cash right now. And the US dollar is rallying because they're not buying the dips. With yields on bonds going up, they have other opportunities right now, and they're not quick to jump back into stocks. Therefore, I think that new buyers will come into the market only when sellers come down on their prices. So I see a lot of profit taking in the near future, stocks coming down, and there will be genuine opportunities. But you have to pick and choose. In regards to where the opportunities are, I see that consumer staples are at 52-week lows. Very good brand companies, talking about General Mills, Kimberly-Clark, Colgate-Palmolive, Procter & Gamble, Tyson Foods. These are companies trading at 52-week lows, and I think that some of the biggest opportunities will be there. Also, the opioids crisis has made some of the bigger pharmaceutical names very cheap at the moment, and we're going to cover those in the newsletter. And the most beaten up sector is definitely the commodities sector. That's where Portfolio Wealth Global is really pounding it hard. We had some major gains with a 25% gain in First Mining Gold, 35% gain with International Cobalt recently, and a 30% gain with Wealth Minerals Corp. And I suspect Tom Beck is setting the stage for even bigger opportunities in the next year. So if people want to check out our complete gold stock review and manual, they can go to portfoliowealthglobal.com/gold playbook. That's /gold playbook. I definitely recommend checking out that report in order to prepare ourselves for the rest of 2018.
Well, since you mentioned gold, let me ask you this. It broke down, over the past couple weeks. After having gone up to 1360, it's fallen below 1300 as the U.S. dollar rallied. That's been the biggest actual rally in the U.S. dollar in about 2 years. But gold didn't really crash. So what do you think that's good for gold, or do you think gold's going to be, kept down for quite some time?
Hey, I'm a huge fan of precious metals. I'm a huge fan of gold. I imagine that many of your audience loves gold. I do too. So we're on the same page with that. And gold is holding up. I don't think a rally is coming in the next 2 or 3 months here, though. I think that what can really change the story for gold and silver is if the Fed raises rates 50 basis points instead of just 25 basis points in the near future. If they do that, that will signal to the investors that the economy is really in jeopardy of massive inflation. And if they continue to do that, I think the overall idea would be that they're trying to stop the stock market from getting too bubblish, and therefore it will slow down the economy and we will have a recession. So first of all, I think that a gold rally is coming. Then I think a commodities rally is coming, and then a recession, which will be good for bonds and cash, but this is 4 or 5 years down the road. The gold rally is coming. Don't get me wrong. Once it starts, wait for it to hit $1,400 in order to pile into the gold juniors. Then I think you'll have a clear runway for about a year or two where commodities will be the best performing sector in the market. Again, you can go to portfoliowealthglobal.com/gold playbook, and we will be alerting our top gold picks in the second half of 2018 as we see this market turning around, if we see this market turning around. If not, we'll wait till 2019. Hey, we're patient.
Well, besides, the stock market itself, how are you diversifying outside of it in order to lower risks in your portfolios, with bonds being so crazy?
Mm-hmm. Yeah, I'm not a huge fan of bonds right here, or bonds generally as an investment. So you want to still you have to diversify, as you mentioned, outside of the stock market. Well, Tom Beck, our main researcher and report writer, recommends private lending, opportunities that generate anywhere from 6, 8, even 10%. A lot of other creative ideas like whole life insurance, as well as real estate holdings. Tom, as I mentioned, got into real estate. He did very well with it back in 2010, 2011. Right now, it's a bit expensive, though. There are opportunities out there, as long as you remember not to chase. Don't chase prices up. So there are opportunities in real estate in the coming year, because millennials are going to start buying. But whatever you do, don't chase. So look, if people want alternative investment opportunities, we have them, because you don't want to be in bonds. You don't want to be too heavily into fiat currency. I'm not a big fan of that. So if people want those anti-fiat alternative investments, they can go to portfoliowealthglobal.com/rocket. That's /rocket, ROCKET. Again, we want to start positioning ourselves now and not in the fiat space. We want to go anti-fiat and alternative investments. That's where it's at.
Well, a lot of your outlook, like when it comes to gold, and you mentioned the possibility of the Fed having to hike to stop the economy from growing too fast, or overheating, or inflation running out of control. One warning sign people are looking at is the record low unemployment numbers that have been generated the past couple months. However, a lot of people also think the unemployment numbers aren't real. In fact, when Donald Trump ran for president, he said they weren't real, and there's websites like Shadow Stats. However, Trump says they're real now, and a lot of stuff he says happens, and he's really a great leader. So what do you think about all this? Do you think the unemployment numbers are real? Is it going to keep getting better?
Yeah, I'm glad you asked that. I believe that the U.S. economy has probably peaked. It saddens me to say that, but I expect that the U.S. is going to fall behind China in the next few years. And this has huge implications for employment in the United States. China will, like it or not, become the world's biggest economy in the next few years. So people need to save up and make sure they have enough money, because the middle class in America is going away in 7 years. There's going to be a 10% of the population that'll be very wealthy, and the other 90% will be lower income. So the time to position yourself is now. These jobs, who knows how long they'll be around. We can talk about employment numbers, but down the road, I'm just not that optimistic about the situation. And that's regardless of who's in charge, who's president, who's in Congress. These are global changes that are happening, and they're not all within our control, unfortunately. So again, the time to position yourself is now, not when it's too late and the changes have already happened. Tom Beck is writing about this extensively in his newsletter over at portfoliowealthglobal.com. So if people want to sign up over there, get the latest on these changes. We're going to talk about new careers. Where are the high-paying jobs going to be? What can we do about it? So we're doing research on that. We're going to keep talking about that. But again, position yourself now. Don't wait until the big changes come.
Well, do you think the tax cuts can help, keep the stock market going up? Because we've had the corporate share buybacks really have been boosted this year. I think we're on actually pace for a record quarter on that.
Right. Well, tax cuts, it depends who you're asking. The corporate tax rate was reduced from 35% to 21%. We've seen corporate tax rate cuts before, but this is a big one, at least percentage-wise. Whether this stimulates economic growth over the long term remains to be seen. Closer to home for many individual taxpayers is the repeal of the individual mandate. This is a big part of the repeal, but it's not enough just to repeal. They need to replace it with something. Also, you've got the 7 federal income tax brackets, same as before. That hasn't changed. Some people will fare better with the new brackets. Some people will do worse. So once again, it depends who you're asking. So only time will tell.
Yeah, it's interesting. It's like we got to really keep on track of what's going on in these markets. That's how I feel about it.
Yeah, very true, very true. Again, it's a watch and wait type of thing. I'm not siding either way politically. I'm just watching, and we're going to keep doing our research, and I hope and expect that your audience, I know that your audience are not just going to believe whatever any government, no matter who's in charge, tells them. No matter who the central banks are, they're not going to believe what is told to them. You have an amazing audience that is going to do their own research, is not going to just trust the government, just going to believe that the central banks and the government have their best interests in mind, because they don't. Okay, let's be honest here. And so we've got to be self-researchers. We've got to be self-investors. We're not just walking into a Merrill Lynch or a Bank of America, Wells Fargo, and say, "Listen, here's my money. I'm going to hand it over to you. Do whatever you feel is best." That's not how we invest anymore. If we want decent gains, if we want any margin of safety, and we're not just going to trust anymore. We've got to be our own advocates. We've got to have access to the best research out there. And that's what I'm trying to do here.
Yeah, and with that thought, I thank you for taking the time to talk with me and the people that, follow my YouTube channel and website. And I just recommend, people go to Portfolio Wealth Global.com to get more information from you.
Absolutely. And once again, if they want the personal portfolio of Tom Beck, it's at /portfolio. If they want all the reports in one place, they can go to portfoliowealthglobal.com /money. That's /money. All the reports are right there, so they don't have to write down every single one. And definitely subscribe to Mike Swanson's podcast there. Keep coming back, because Mike, Wall Street Window is a source, not an alternative source, but a main source of information for me. Should be for everybody listening out there. So stay up to date, subscribe, and do your own research. By all means, be your own advocate. That's what I want to tell people.
Yeah, definitely. That's great advice. Well, thank you again, and have a good day.
Thanks a lot.